Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Weekly for Saturday, April 2nd, 2022. Well, it's been another great week of shows and great contributors. We kicked off the week with a look at some of Turkey's recent retirement system reforms. Let's take a look.
Sure, Jeff. Indeed, Turkish pension system has three classical pillars. The purpose of Pillar 1 is to provide a basic old age income, particularly for the lowest income percentile of the population. And this unfunded public pay-as-you-go component both include flat rate supplementary pension and means-tested income safety net. So in this pillar, the retirement age for women is 58 and for men it's 60. And indeed, I think this is a really important information. The first pillar of the Turkish pension system, Pillar 1, has one of the highest replacement rates among the OECD countries. It's almost a net replacement rate is close to 100%, which means that the ratio of average retiree's salary to a worker's salary is about 1. So moving to the second pillar of our pension system, it has one big mandatory occupational pension plan called OYAK, and it's for military personnel. And the contribution rate is 10% of monthly gross salary of military personnel. And also 50% of OYAK's assets, almost half of its assets, invested into the subsidiaries of OYAK, its own company. And OYAK has a great success investment performance compared to other pension funds, I think. And it has beaten inflation for over the past 10 years with its investment performance. And then when we move on to our third pillar pension system, it's fully funded DC. It consists of fully funded DC pension schemes with voluntary participation. There are currently over 7 million participants in our voluntary components. And indeed, if people want to retire from this system, they need to complete 56 of years of age with 10 years, minimum 10 years coverage periods. And differently from many other countries, in Turkey, portfolio management companies are responsible for the active fund management of our pension funds. So pension companies set up the pension funds, but the fund management, portfolio management companies are responsible for the fund management of these funds. And in 2017, Turkey has introduced auto-enrollment policy. And now there are over 6 million workers in the system from either public and private sector. In 2013, Jeff, Turkey introduced government state matching contribution, about 25%. And in Turkey, and also I think in Poland, state has really generous financial incentives for its participants. So in 2017, after that, we introduced auto-enrollment. But three important regulations took place recently in the Turkish pension system, which I really want to mention. First of all, our state matching contribution has been increased from 25% to 30%. Then now, under the age of 18, young people also can enter and join to do our private pension system. Their beneficiaries will be their parents. And finally, pension funds now are traded in a platform called Turkey Electronic Fund Trading Platform now, which increased transparency. And now participants can also buy other mutual funds, pension mutual funds from different pension companies. And this will increase competition among pension companies and pension funds, which will, I think, in turn also reduce some management fees and etc., these types of fees, and to benefit from economies of scale. I think increase diversity, fund diversity, increase transparency, and increase diversity. This regulation is really important. Jeff, Turkey introduced auto-enrollment in 2017. And before Turkey, indeed, some developed countries also tried this policy tool, and they are really successful, like New Zealand and the UK. They promote pension savings via auto-enrollment, okay, but in Turkey, if we move on to the parameters of auto-enrollment, the target population is people from either private or public sector who are under the age of 45. The opt-out window is about 2 months, but after 2 months, also participants can cease their membership in our private pension plan. The employee's default contribution rate is 3% of employee's gross monthly salary. And I think Turkey is an exceptional country in terms of default investment option, because in Turkey, instead of life cycle funds, interest-bearing or interest-free funds are offered as default investment options. And default fund management fee is capped at 0.85% of asset under management. But unfortunately, the opt-out rates are high, like in other emerging market countries who introduce auto-enrollment. When we look at the main reasons why people opt out from the auto-enrollment system, I'm speaking for Turkey and some of the recent surveys from other countries. The first reason is lack of affordability and high level of debt and expenses, Jeff. And secondly, of course, I think informality, high level of informality is a really important obstacle to achieve higher coverage rates in auto-enrollment systems in emerging market countries. But for example, when we look at the Central Eastern European countries who introduce auto-enrollment, for example, in Poland, also opt-out rates are really high, but informality is not so high in those countries compared to Latin American and African ones. But why this is the case? And because I think lack of affordability, as you mentioned, is a really important obstacle, and we need long-term reforms to mitigate this issue. But we can implement auto-enrollment policy with other policies, I think, to tackle with this issue and to promote pension savings in also emerging market countries.
Next up, Saved by the Bell, 24 states have personal finance requirements before you can graduate. Let's take a look.
Yeah, Florida really leading the way in lots of different areas, but that's neither here nor there. So, we talked about what we're going to discuss on today's show, and you said, I think we really ought to talk about financial literacy in high school. And I thought, okay, great. I thought, I wonder if I would have even paid attention, and therefore I wonder if it's even worth doing. And then I realized, of course it is, because some of the stuff that they tried to teach me in high school stuck. And that's the challenge and the opportunity with everything that we do as human beings, is just like financial literacy education for employees at companies, not everything's going to stick, but some of it's going to stick. And down the road, when you're ready to make some kind of a financial decision, you're going to have that knowledge that was passed on. So, long answer to a good question is yes, all states ought to have some type of financial literacy requirement to graduate high school. And a lot of the things that we used to teach young people, and this is, before my time, like home ec and shop class, these things were not taught in my city or state when I was growing up. I would have benefited from. So my guess is that there are so many demands that we're placing on schools, and we're teaching to be able to help our kids pass standardized tests and stuff like that. So like any big problem that I'm looking at trying to solve, I say, okay, what's going on in my local community here? What's going on in my local schools? And if I look at that and I say, well, this is a problem we need to have home ec, or we need to be teaching on how to balance my checkbook, or how to manage a credit card, or should I have a credit card, or how do I do my taxes? Well, that's something that you should take on personal responsibility for, and talk to the school board about, and try to get that added to the curriculum. That's a good question. What does get it right mean in the first place, right? And how many hours are devoted to teaching this? How deep are they going with all of it? As you're saying that, I think it might be cool to have some kind of, and I don't really like the term, adulting course or an adulting class for seniors, where you learn a little bit about, putting together a grocery list and a grocery budget, and how that, so it's more of an integrated approach to being a grown up and everything that you need to be doing. But I haven't thought that one all the way through. So yeah, it strikes me that we've just come up with a great solution to this problem of making it an experiential, Saved by the Bell type scenario, where you go through all the different levels to really what that means: buying a home, shopping for groceries, having a child, starting a family, all those kinds of things. And you could actually make it fun. And if you're able to do that, that's probably when it sticks a little bit more. Well, I think that the first thing is that you need to be making sure that you're talking to your own kid about money. I think that it's great when schools are filling in gaps, but I think it's your responsibility. So there's that first. And then I would start with the actual teacher, because it could be that they're already incorporating some kind of financial lessons, or it could be that there's a nonprofit like Junior Achievement that is in the classroom that is teaching on these things. So talk to your teacher, and if they can't answer the question, well, then talk to the school. And if they can't answer the question, or if there's no curriculum being taught, well, then yes, I think then you can go directly to the school board. But I would always just start with who is actually teaching your kids. So start by talking to your teacher, 1,000%. And it'd be fun to, if you had class with 20 kids, just to have a parent come in, once a week and talk a little bit about what they do, but then incorporate some kind of an important life skill that they would want to share or be comfortable sharing. So there's a lot of creative solutions to this. I don't want to call it a problem, but it's a problem that if we are creative about it, and again, try to make it a little bit of fun and interactive, then it's probably going to be more successful.
Well, we're halfway through a look at our best segments for the week. When we return, the second half of those great segments. You're going to want to stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
It's not some magical number, and it's not something we just achieve at the end. It's a feeling of freedom to live our lives the way we intended, through the ups, the downs, all of it. This is financial security, and Lincoln Financial Solutions will help you get there as you plan, protect, and retire. This is Lincoln Financial.
Welcome back. Life insurance can serve as a retirement income generation vehicle as well. We discussed, so let's take a look.
Well, all right, let's talk about the properties of cash value life insurance, because that's really what you're talking about. How can we use an insurance vehicle to build cash that could be used as, well, for any purpose in the future, but looking to retirement funds that could be made available in retirement? Life insurance, permanent life insurance, that is what we used to call whole life insurance, but now comes in many other forms. Has three very advantageous tax properties. One, and I think most people know this, death benefits paid under a life insurance policy are free of income tax. That's point one. Point two, a cash value life insurance policy accumulates cash and the earnings on the cash on a tax deferred basis. So as money is growing, there's not current taxation on that money. And thirdly, and this is maybe the most important when we talk about retirement benefits, cash value that's built up over the years can be accessed and withdrawn from the policy over a period of time on an income tax-free basis. So you have a unique property in terms of getting money out of what could otherwise appear similar to a Roth IRA, but without the constraints of a Roth. You could get money out at the back end in retirement, income tax-free. So those are the properties. And then the question becomes, well, how do we do this? And how does this form a, let's call it a separate asset class, if you will, in your retirement planning? So we're certainly not talking about putting all your eggs in one basket. We're saying a permanent life insurance policy, if funded properly over one's working lifetime, could produce additional income in retirement as a supplement to all the other qualified plans or other forms of savings that you've accrued during your working years, looking to build a meaningful retirement benefit. Well, there are numerous types of choices of policies that are available. Whole life insurance, which has been the bellwether of the industry for 100 years or more, is essentially a fixed premium product that builds in cash value within the policy on a predetermined basis, and for the most part would distribute a dividend that would enhance the return over time. I'm not going to get into all the background of what the dividend represents, but that's a form of insurance. What's evolved in the last, 30 to 35 years is a flexible premium policy. Generically, it's called flexible premium adjustable life. The industry calls it universal life. And those type of products allow you to either select a product where the insurance company credits a rate of interest to your money in the policy based upon its portfolio rate of return, or you can, or you can find a product that allows you to select from an array of investment accounts within the policy that could look like mutual funds. They could be index funds. They could be growth funds. They could be international funds. They could be bonds. They could be any combination of all these that suits your risk tolerance and fits into your long-term objectives. So there's a whole array of products out there that are available. And you really need to find the right product. Well, first you need to find the right advisor who can properly advise you on which products are suitable for you and help you to understand how these products work. So there's no automatic fixed solution to this. It's a concept that should be explored. Well, you have to have the ability to pay the premium and put money into these policies. So for those people who are living on a fixed budget, it may not be realizable, at least in the short term, because they're going to have other expenses and so forth. So I would not call this an affluent person's concept. Although the affluent certainly can take advantage of this. What you really need to do is to find a comfort level to place money consistently in a policy and let it grow over the years. And you can start small. With whole life policies, they're a little less flexible, so you can't really alter the premium over time in those products. Whereas flexible premium policies, you can. So you can start out with a small amount of contribution, and as your distributable income after tax income grows, you could put more money into the policies and let them grow over time.
And finally, we took at whether the job market of the future can support an older workforce. Let's take a look.
Well, I think there's long been talk about this demographic transition where we have a very big baby boom generation. They are slowly retiring these days, but there's still a big generation. And so we have a fairly old workforce relative to past trends. There's going to be a bit of a fall in that maybe in terms of how old the workforce is as the baby boomers leave the workforce and until the millennials kind of take their place. But going forward, generally society is growing older. And so I think the overall trend is for an older and older workforce. Yeah, the US was a bit of an anomaly in how young we were for a while. I think our fertility rates were relatively high compared to most Western European countries. They're coming down, at least they were. I don't know how it's changed in the last year or two of the pandemic, but yeah, we've kind of been slowly converging to the rest of the Western world in terms of how low our fertility rates are and how correspondingly old our populations. Yeah, there's other studies besides ours that kind of look at whether automation increases as the workforce gets older and find some evidence that that's the case. We didn't look specifically at that, but like you said, there's certainly a certain set of occupations that are more congenial to older workers and maybe more complementary to what older workers can do, and others that are less so. So, for example, the most congenial tasks or occupations we found, I believe, were legal occupations. And you can imagine that that's an occupation where people can keep going for a long time. The least friendly to older workers, this is not personally friendly. I'm sure they're all friendly, but the least congenial to older workers' abilities were, I believe, mining and extraction and maintenance, and that kind of very physical job mostly. Those are the things that older workers generally have the hardest time. Yeah, there's a lot of research showing the health benefits of work, and it's mixed. I guess it probably depends a lot on what kind of work you're doing. But yeah, we always recommend that people who can and want to work should keep working. It's the best thing they can do for their retirement security. What does it mean for people who are older and want to keep working? Well, that's part of what the study was trying to get at. Will they be able to find jobs that they can plausibly do? And I guess the answer was kind of optimistic. At least we didn't find any strong evidence that the future composition of jobs would be particularly bad for older workers. There was some initial analysis that we did that was a bit more pessimistic, I guess, where we looked at the jobs that older workers are doing now and found that those jobs are going to, at least the Bureau of Labor Statistics believes those jobs will kind of fade out or decline at least in another 10 years or so. But when we did a more careful analysis based on what jobs older workers could do rather than what jobs they are doing, that kind of analysis didn't really find any strongly significant results, which we interpreted as good news.
Well, certainly great segments. I want to thank all of our great contributors this week. And that wraps up this episode of BRN Weekly. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the latest curated news in retirement, lifestyle, finance, wellness, you name it, we cover it. Take a look at our daily newsletter, The Morning Pulse. And by the way, it's free. Want to search our archive? Check out our latest content. We'll check out our website, www.broadcastretirementnetwork.com. And of course, our streaming partners, Amazon, Roku, Samsung, over 100 more to pick and choose from. We're back again tomorrow for another edition of BRN Sunday. I'll be joined by members of the media, academia, and financial services as we analyze all the news and events for the week. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the first lifestyle and wellness network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.